Okay, let's take a look at what happened. So yesterday we had our dive into the close. The bears did their very best to come down and pressure the bullish position, which the root here, so we have our root. Right off the open, we had our inversion level there. That's this yellow line. Remember, that is the money tick. You can pull that up and you look for the high value that was right off the open, and you can see the bears pushed it down. They were not able to get it through that spot. And on the ES, you see that's pretty much where we got to. And the market turned back around. The bulls were able to defend. Well, I don't think they really had to defend their position. We had some. I haven't loaded this chart up yet because it's a pretty decent one. Oh, I have. Never mind. If you remember yesterday, the bulls had picked up some insurance positions here and here, the 250 and the 305. They're in the money puts, and they're big ones, and they insured the lows. And the bears had a hard time with those lows because those lows were essentially risk neutral. So last night we saw the market pop back up and go for the counterparty, which is these guys. So right now, that's what happened this morning. We had ourselves the gap up. It was over the highs. These bears were in trouble. If any of them hung on, I don't think a lot of them hold on overnight. I think they hedged their risk and stuff, especially with that. If they didn't pick up some hedge or whatever, they're ridiculous. So this morning the market opens. Now that we got through that, if you were following from yesterday into the close, let's take a look at what's happened so far today. I mean, immediately right off the open, you can see decay moves down. Now, you could look at this and you could say, well, velocity was down and it crossed over at the open. Now, the reason I don't track that is right off the open, I have like a couple of little special rules that I'll use to look at samples off the open. What's really important to me is that that we've been expecting it. And that's like a day where it pops up and it's just been going towards that sample all day, never gets there, and then the next day it crosses over. That's something I'll use because the anticipation for it was so long, was drawn out, it was really irritating. It took then I'll look at that. This, I don't think I was at any point into the close even anticipating a bearish sample. So I'm not interested in that. But off the open, decay moved down, and we have trapped orders pop up right there. So our first bullish position, copy this one here, is right here. And their stops are going to be, down below. I don't think they're going to be holding stops for the whole gap. This looks very similar to yesterday, but right off the open. But they don't have any bears right there. You can see there's no bearish sample. The first bearish sample doesn't happen until right here, where decay finally gets up and crosses over right there. And we have just a small amount of bears come in and take up some liquidity. Now, let's duplicate this right there. Okay, now look at tension. This was the big deal for yesterday, was should these bears here drive this down on elastic market? And I didn't think so, because we were only at like negative 22%. Yeah, Pierce? No, I don't have any of that. So at negative 22%, just not a lot of, it's not too high. So I didn't think that moving this back down to zero was really a good play for the bears. The bears, can I finish up this? Hey, look at me. Can I finish this up?
Yes.
Say yes. Say yes. That's okay. And you hang out in your fort. Okay? You have cereal over there.
Cereal?
No, you ate the rest of that yesterday.
Oh, so...
There's some cereal over there you wanted. Blueberry cereal. Okay. So this morning we opened up and tension was higher. And I think that makes total sense. The bears didn't have elasticity high enough that it was really necessary to drive this back down to zero. I just don't think it was. So looking at the open, you can see right as this moved down into that bullish sample, tension also moved down. And the bulls hit. And look at this. The bears, who were right about in here, not there, but right about here, they, right there, they didn't really impact tension. It took a while before this finally moved down a little bit, and we had a bit of a move down on tension right there, but nothing significant at all. So I do think there's a group of people who are stuck right here. There was a little bit of an impact, but I mean, it wasn't aggressive. It wasn't anything. It was as soon as, and this is the same thing that happened yesterday, as soon as the bears had any impact or hit anything, the market said right up. The bulls were just completely predatory again this morning. They waited for the bears to come in and pick something up. So, yes? No.
I'm gonna make my own cereal.
Okay, if you can find some. So, what's going on here is this moves down. I heard that. It moves down, and you could see that this wasn't really above, so I don't track these little switchbacks where it was up for one bar and then flips back down. I think that's just noise. This one looks better to me, though. It was up for a little bit and then pops down. This is something I'll track. I don't really look at these little one-bar crossovers for the switchback. So we have crossovers for the bears, 3 of them. Got a little noisy. I'm not going to mark them all because they're all about the same price. And then finally, I think right here, we had a switchback for the bulls, and they were basically just sitting and waiting. So I'm going to mark that. Let's see. I want to make sure I duplicate the right one. Right here. Okay, so what I see is the bulls being predatory, just like they did yesterday. They were just laying in wait for the bears to come in. As soon as those bears did anything meaningful at all, they pushed the market back up. So after that, we have it drift back up, and the bears get another sample at the same price. This is like the 4th one, but I'm only marking out this one because I think the previous ones are a little noisy. I'm going to mark out this one. It's a little bit better price for them. Okay, so what I think is important here is that you'll notice that this really didn't push up far enough, I think, to knock out an institution. They're not going to jump out because it's 3 or 4 points against them. So this to me looks like a double down, which is always stupid. You just don't do this. It is bad decision making. If your position isn't working, if it's not going the way you want it to, if things are not playing out correctly, and especially if you don't have control of the probabilities, doubling down just doesn't work. This has never worked. So we're seeing right here, this is a double down. This is how it looks to me. And let's take a look. Was there any impact through this range? No. And then you see as this rises, we get a little acceleration there. I think people realize they're in trouble as this rises. Again, we get some noise. And then right here, you see it was up for a couple of bars and then finally gives us down. Yes. I think there's some in there. Yeah. So right here we have bulls come in and they get a sample. And again, they are interacting, they're pumping tension. The bears are struggling to impact, failing to have a proper impact on tension. This is pretty clear-cut stuff. And as the market moves higher, you know, we see this accelerate a little bit here as I think a lot of the bears realize the trouble they're in. And the market basically just keeps moving in this sort of same thing it started into yesterday. So moving from here, the next option here for the bears is a multi-day decay retest. And you see that shows up about here. Now, these are an important case to remember. The question is this their last option? Is there just nothing else for them to get? And right now, yeah, there's nowhere else for them to position because if decay continues higher, there's no zero test velocity, no zero test. There's nothing left here. So yeah, this is their last option. The second point to check off is they seem like they're wanting to participate. And I think we saw a little bit right here. Nothing amazing, but I guess a little. They've had no edge, no advantage, no wins, just total slaughter. So I'm going to pay attention to it because I think it mostly checks off both of the boxes that I'm interested in. So looking here, you can see there's our trapped orders. So you get the retest, you get the trapped orders, then you get the lurch. Right. There's the stocks pushing new lows right after there. So we're getting a decay retest here. And the thing with the decay retest is they tend to give you a little kick off the first point or two, but then they abandon you. And everybody knows your stop is just on the other side of that entry. Your knee hurts. You can do it. You can do it. I think you can do it. I believe in you. You can do it, buddy. So right above this right here, there are going to be stops, and those stops are open interest. That's open interest. Remember, liquidity is all about open interest theft. The number one thing that matters the most about liquidity is that you're thieving open interest. You don't want to be the one who makes it. You want to be the one who uses it. So as this pushes higher, there's some pressure here, and you could watch maybe in this area here, there's a little something that happens. I think no, really it doesn't happen until about here. So I'm going to mark that out as a liquidity spot. You don't have anything in there. You gonna want me to pour you a dish of milk like a kitten? I'm not gonna pour you a dish of milk like a kitten. Oh, you want that cereal? I'm gonna get this kid some cereal, and I'll be back in a second. Okay, so our bears finally get a little bit of liquidity to pick up here. Take a look at their response. Price sort of leans a little bit-ish, I guess. Nothing, just nothing. Nothing. So the bears have failed again and again and again and again. This is what happened yesterday. So what's going to come up next? Now that we've sort of modeled this out, we can see where that people are at. Well, let's take a look at options actually, see if we have any insured lows, if the bulls have insured their position. And I promise not to miss too much this time. Okay, so here we go. Here's a spot right here. This is our in the money put, and it's at that strike. So hopefully your premium comes to maybe here, and that's going to be your break even. And if you have some longs from this morning, those will be here. And this is the captured profit. That's the actual value here is right there. That value's been captured. I think that those hedged a little bit, but again, it's like 200. And yesterday we saw at least 550. So partially hedged again, same as what we did yesterday. Some hedge, so it's a little bit of the lows having their risk neutralized, but some of it, we do see a little bit there. As for the bears, we haven't really seen a decline in price enough that you could get into a position that would properly deal with the risk of holding. So I see that. Looking at this here, Again, this overnight, you see over the overnight session, we were able to get above the value area, actually get some distance in here where, then it breaks inside. But this is because you see the point of control moved up, and that also shifted this up. Right here, you see this. We are staying inside the value area. This isn't breaking above it. There is more and more volume at higher and higher prices. Just like yesterday, that's a supportive thing. You want to see more and more volume. So the higher it goes, the more we get. The volume profile is all about seeing if there's more and more volume at further and further prices. And if not, then the market will go back and look for commissions. It's just over and over and over. And this is really, I think, there is volume up here. That's a supportive thing for the market. There's stuff up here. The market will continue to look where the orders are because it's designed to make money for its masters. Okay, so what's next? Now that we've looked at the options, we modeled out where everybody's positioned at. Now the first thing that I always think is, well, what kind of destruction could they do? And like yesterday, we had to track out the root position for the day, and today's root position is going to be here. Yesterday's was here. So the bears were able to come back and test that. That's why I mark out the root positions and stuff. These are the secondary positions, which had not much sweat, if any. If you were limit ordering in and trying to be a little conservative on not chasing price when it gave you opportunity, but limiting in where you thought, I think you could have done really well here. So I think we could totally mark, I'm going to duplicate this out. This is going to be the place to get to. And I'm going to, when I look at all this stuff here, I pick out the thing that started it. That's typically my mentality, always. So right there, that's going to be the spot that I go to say, well, here's the spot. The bears started this whole thing. This was essentially the spot that screwed them over. And then they doubled down, and now they're upside down twice, and they're getting into a third position. And I'm still waiting for, there was a little acceleration here, but price, this looks more like pumping because we weren't to the levels where that we were knocking stops out, hitting risk tolerances. So I want to see price up here where the bears are getting pressure and then see an acceleration. So I'm still sort of waiting. I'm waiting for an acceleration, and I could go, there it is. There we've obliterated the bearish side. So right now there are bears just flat out upside down in positions, and they're hemorrhaging returns. So I don't expect this to come down at all, even a little. I do not expect a pullback. I expect this to blast out the top and wreck these bears until tension curls. Tension will tell you when they're dumping. That's a big deal. I don't think that these guys have dumped their positions yet. I think they're still holding. They've doubled down, if not quadrupled down. Like this is their first spot, and this was second and third and fourth. I don't know. For me, this looks like a triple down. Doot, doot, doot. I don't think the bears should come in. I don't think they should get any advantage. I don't think they should get an inch. I think this market should just rocket and take out their risk tolerance. Their backs are against the wall. They have nowhere to go. We're finally over the big scary 4,000. So everybody has to start going, wait, so do we think 3,000 something or do we think 4,000 something? And that for some reason is difficult. Check this thing out. Look at that. The size of this thing is just, it's going to last me a whole into the close. So that's where we are right now. Now let's take a look at our possibility space. That was a little opinioendo in there, but our possibility space. Possibility space, of course, is where are all the players sitting? So if the market pushed down, first we'll look at the immediate players. We would see bulls. Bulls would get sampled. To find bears, you would have to drive the market down, push through the bullish position, and it would take, like yesterday, a ton of capital, which ended up getting pretty much just turned right back over. Those bears did terribly. Unless, of course, they were, on the phone at the bulls and that was planned. Otherwise, it looks like the bears did terribly. They drove the market down to do nothing but sample. to give the bulls another opportunity to add to their position. So again, driving the market down is not looking favorable for the bears at all. It would be totally foolish for them to inject capital. Yesterday was like, because they had this position. Today, it's like, no. You have nothing here. You guys are tripled down. You have no advantage. You haven't let go of your spot. You guys are flat out hemorrhaging. It would be so dumb to inject capital. I 100% think that the bulls are sitting here waiting, just begging, just dump a couple $1 million into an algorithm, please, so that we can immediately catch it and destroy your faces. That is, I think, just the mentality right now of the bulls. It's just, please run an algorithm. Just please. It'll accelerate the process. I don't think the bears have anything. So, and the reason I say that's because an algorithm moving the market down is going to just hit this. The bears are still holding. Looking at tension, can this continue at negative 45%? Can we keep doing this tomorrow? We're getting to that point where it's like you're starting to run out of room. If this continues up and we get to a close about here, probably be looking at like 48%. And if this opened like here and kept going, we'd be running into negative 70 pretty quick. And the question is there something on the horizon that could push the market to set? You can't just go to 70. You can't just cause a herd to run. You need a reason. Like, you could get some to run, you can get things pretty far, but at the end of the day, to get to levels like 70 and 80 and 90, you need the whole group freaking out in a direction. Like the pandemic, it got us down to 90 because everyone was running in the same direction. So getting to 70, I start asking the question, is there some reason? Is there some news event that could come in and get the herd going? Now, I don't know. There could be. I don't think that the bulls actually need a news event right now to drive out these bears. We could get another 10 or 15 points out of this market without any news mechanisms at all because the bears have tripled down. We don't need a news event. Screw it. Don't call up the news centers. We got people here. Now, but if you want to conceal your efforts, you might need to call up the news centers and say, hey guys, there's going to be an event and you need to come up with some reason why you're right. Or whatever. Just make it up. It won't matter. You'll know it when you see it. And then just get on the news and start yelling about how it was your fault. Here at the news center, we said the news that drove the market up. It's like they have the same problem Trump did. They all hated on him for it, but Trump loved to tweet and then see the market move. I think he just loved that. And I think the news has the exact same problems. Probably why they hated him so much. But they remind me a lot of Trump in this aspect. They will come in and take credit for everything. They'll talk about how great they're doing and they're causing the market. So you need to pay attention to the news center. I think that's probably what's going to happen here. We're going to see something about that play. I say that as an expectation so you can watch and then you can say, okay, our expectations are being met. The market did drive up against the bears and then the news came in and tried to steal credibility for those deaths. So if we close like 48, 49, the market's getting a little hot. So the thing that's looming right now, let me back this up. I want to clarify something really quick. Through the morning, I just want to make sure you guys, through the morning, through like this section of the day, you're focused on how the market's going to close. Tension looks at, can we continue into the close? How's this going to close? Close. But after a certain point, and I think the certain point was about here, where the market had turned upside down 2 positions, all of a sudden it was no longer, there's this moment in the day where it's clear what's going on, like abundantly clear. And you stop focusing on the way it's closing. This is not about how it closes anymore. This is about tomorrow. And so I differentiate between these two. And if you think of them as like in the morning, you have 100% focused on the close and 0% focused on tomorrow. Through the day, they switch like this. Does that make sense? Am I being clear? through the day, you get to the point where that you have, sure, 100% of your focus, but it's sort of like half and half, 50-50. But by the close, you should be, and I actually think it's a little faster than that. It's like this. And I also think this is one of the reasons that you get this sort of parabolic looking volume. I've never covered this philosophy, but this is, if you plot volume, essentially every day you get this parabolic look. And I think that's because here you have 100% focus on the close, and here you have 100% focus on tomorrow. And it's the I forget what that's called. Gosh dang it. It has to do with flashlights. If any of you remember, if you have a flashlight, how much spill it has, like they'll like fill an area versus being a point, like almost like a laser beam. Anyway, it gets very focused, so you have all that focus, and I think that's why that volume tends to look like this. Because people know, you know, oh well, at the close, by the close of today, it's going to be up or whatever, and then at the close, they're like, oh well, this is going up tomorrow and into the next. So you get this crossover of focus. So looking at tension, at about this point, you stop going, well, how's this going to close? I kind of have an idea. And then you start thinking, well, how's it? So tomorrow I'm sitting here going, well, can we do this? And it's like, yeesh. So the market, yeah, is going to continue to take out the bears. I just don't think we should give the bears an edge right here. They made some blunders, and you have to pay for your mistakes. But in terms of tomorrow, we're going to be looking at elasticity. So I need to get you ready so that you see it coming. Elasticity is a nod. What it will look like is some sort of zero test. We come down, here's the zero line. We get our zero test right there. Maybe it's decay, could be velocity. And then the bulls do nothing. So when they do nothing, this will be the nod. And then the bears, so at this point, cut right there, we'll come in here. It's going to go up. The bears will need a position to operate from, and then they'll want to drive the market down. And the way that the bears get this to work is that normally you'd have a bullish test, right? You get the nod that they do nothing. There's no price response, so you don't see price shoot up. It would be like, price would look like, here's your bullish sample. There's just, it's not that it fails, it's that they do nothing. There's just no action. And then you get a bearish sample here, and what the bears think to themselves is, okay, you guys are stepping out of the way, so we can safely drive this down to, and I want you to know these are different, through 0. So once they see that the bulls have done nothing, they're going to do it. Otherwise, the problem would be is that the bears picking up a position would result in instant death. So they wait for that, and then they will push it down. So this is how it will look for elasticity to get going. Then the objective at this point, once we have a bearish sample. So here's 1, 2, 3, 4. So they push it down. 5 will be, why are they doing it? And they're going to want to drive tension down. So tomorrow, this would be perfection for the bears. They get tension all the way down to 0. They would love to see that happen, and it would even be great if this gapped up and prices looked like this, because that would mean they could pick up a position and basically get a drive and make some money while they destroy the high levels of tension. So perfect for the bears. This drives all the way down to 0. Then at this point, of course, then we get the sneaky bears who are going to try and drive tension through 0, but we're not going to worry about that yet. So this is what's coming up tomorrow, elasticity. The reason I'm talking about this is because we're getting to the levels where it's getting a little hot. It's getting a little hot. So you need to watch out for this. You need to pay attention so that tomorrow when it happens, you're not going, well, I saw a bullish sample and just couldn't. No. You need to say, there it is. Oh, here we go. and you operate as though the bulls are going to win until you see them do nothing and the bears take up a position. So remember, the bullish position will have no response on tension. You're not going to see it supportive. So it looks something like that. And the bearish position will come in and have a response. You'll see, so the bears are hitting and that's what's going to bring tension down is the bearish position. So keep your eye out for that. It's not a guarantee, but because tension's getting pretty high, pay attention. Okay, so we've got a little bit of a forecast for what type of thing to expect in tomorrow's market. What also could happen, and it's not as common, but you get things up a little bit hotter, and then you just see the market sort of slow down. And what happens with this type of thing is you get what's called amp change. An amp change is kind of a neat trick, I think, where you have an oscillator that crosses zero, and the bears are here, bulls are here. And then right here, what happens is you destroy the amplitude, which is this distance here. And suddenly it oscillates like this. And this is kind of a neat trick because if the amplitude's not big enough, you can't get it to cross back down. And an amp change is one of those tools that bulls love to use to wreck the bear side, is by dropping that amplitude suddenly, and then the bears can't get tension down to zero, even close to it. And this ends up supporting the market. We've seen this a couple times. Let's scroll back real quick here. Find an amp change. Here we go. Here's an amp change. You could see pretty clearly the amplitude looks something like this. It's this huge amplitude that should have, but then it goes, you see that? The amplitude got destroyed. And the bears, no matter how they try, cannot impact tension enough to even get it close to zero. And these amp changes, which happen a couple times, probably 2 or 3 times a month, drive trends. They're great. They're great tools. It's a useful tool. They're a little bit difficult to pick up in real time. But if you're tracking the positions with liquidity and you're seeing their impact and the ebb and flow, you should be able to pick up on it pretty quick if that's a tool that they're going to use. And it looks to me like we have this really wide amplitude. It hasn't really started to curl back down. This is really wide amplitude that sort of makes you think this. And if we can get the bulls to eat up the amplitude, that can be a tool in their tool belt to just destroy or mute or suppress the bear side. So that's another thing to pay attention to going into tomorrow, because we're going to get into a little more crafty tricks if the bulls want to continue moving this higher. Otherwise, it's elasticity, and that's just how things work. So that's where we are. There's not much else to do. If the bears come in and push this down, they're going to run into a bullish sample like they did yesterday. And outside of that, the bears need elasticity, and their best gameplay, I think, the best play for the bears is to just get out of the way and quit piling it. I think that's their best play. Let the market move up a little higher, get us to 4. No. Oh, why do I just look at this and I think 405, 4005 looks just good to me, but that's not. I would think like at least 415, getting us through this 4,000 level, getting that idea that, hey, we broke through, we're on the way. A lot of bears are going to dump their position. I know there's a lot of options to unwind. We can do that. But I think what the bears should do is just move out of the way, see how high they can get it. And then if you get all the way up, they could get a 401 on the SPY and then sell that, something like this down in an elastic market tomorrow. That would be the best play. Just let the bears get their risk tolerance hit and go ahead and pick up a better price tomorrow. Are they going to do that? I don't know. I have no idea. Should they? Absolutely. Yeah, they should, because that would give them the best tension. That would give them better prices. They have more room to run. They'll make more money. Right now, if they drive this down, they're going to run into exactly what they ran into yesterday, which was, well, you guys are basically getting obliterated, so why on earth would the market want to support you? And it shouldn't. Their algorithms are going to have some serious bouncing problems, just like yesterday. But sometimes bears just do whatever they want. They don't care about structure. They all just scream go. And I do think maybe a higher level, sort of just abstract, there was probably a lot of people who thought this was going to close the gap. And it didn't. And so there's probably a bunch of gappers who got stuck right there. And this diving down, it's like the same thing we did yesterday. So that's where we are. I think, again, right now it's not just like yes. This just reminds me of yesterday. It looks like buying into the close is going to be a little bit riskier. If you're holding from earlier in the day, you'll want to pick up a put. If you have a long position here, you want to get a put such that your strike, well, really it's the absolute value of your strike minus your outright position is greater than your premium. This is the goal here, because this means you have zero risk and you have a guaranteed return. So if you have a position and you can pick up a strike that's further away than the premium and you get a put and you can hedge that, you will capture some returns. And if tomorrow the market blasts up higher, you can capture some of that. The trick here, though, is if you're going to pay 70% of the range in your premium, and it's like, well, do you expect this to really go like 100% the range higher? If it's a 20-point range, you expecting this to go another 20 points? Because you're going to need it to double the range at least if you're paying 70% of the range to hedge out your position. So you got to sort of think about that. But if you can capture profits with a zero risk position, that's the best spot to be in. Is there milk in your mouth? You swallow that milk. Thank you. So the best position to be in is to have captured some returns and leverage those tomorrow. You'll have some profits. Otherwise, if you're going to day trade, which I don't think institutions operate this way, you just dump instead of trying to capture those returns and say, hey, you know what? I saw what was happening. I got in, I got out, I'm happy. If I were going to have a position here and I were going to manage this, I'd probably have a break even on my position. Yesterday, same thing. If I were going to intraday trade, this would have gotten break even. I think the best play was to pick up a put with the cheapest amount of premium that allows you to capture some profits. Basically, give up some profits now for more profits in the future. That was a good play yesterday. Today, similar play. But do what you want to do. Hopefully, you're able to see what's going on here and understand that I just don't think we should bring this down. You tricked me. You tricked me. I can't believe you. He made it look like he had milk in his mouth and then he fake spit it on me. Okay, so go hang out. I'll be done in a little bit. Okay, so I don't think that this should come down, and hopefully I've been clear about the reason for that. You have to pay for your mistakes. Markets make you pay. You mess up, you get to pay. And institutional level is important. There's a big reason that I look for institutions and I don't care about the retail market. The biggest reason is that the retail market is like this little tiny canoe in a river. Well, the river looks like this. In the Suez Canal. And they can do a U-turn. And institutions are like the Ever Given. They can't turn around on the canal. So when they get trapped, okay, buddy. Okay, you're tricking me. When they get trapped like the Ever Given, they're stuck. They can't turn around on a dime like a little tiny boat. So you want to ignore retail because retail can flip-flop. They can be a buyer and then a seller. But, institutions are like the Ever Given in the Suez. They can't. This position couldn't just cover on a dime. Okay, I don't need to know every time you burp. You're gonna have a scar on your forehead. Okay, go grab the tablet, buddy. So the reason that we look at tension, the reason that we look at trapped orders, the reason that we look at momentum, broad market momentum, is because we're trying to model out big, huge ships in the water. Don't care about the retail market. They're too flip-floppy. This position here and this one, these guys can't just dump. If they just executed to hit the mark or mark to market, price would just sweep up as they would create demand across the entire exchange. It would absolutely crush them. So as the market moves up, what they do is they use other tools to guarantee their liquidity and stuff like that.
Door.
But they can't turn around. So when they're stuck, they're stuck. We don't care about retail. So when it comes to things like this, like trapping gappers, yeah, I find gappers to be the most annoying of the bunch, but these guys don't matter. They're retailers. Institutions aren't gap trading. They're trading the conditions. They're trading probabilities. I don't care about the gappers, but you know, we can point them out because there's probably a lot of gappers and a few institutions. Okay. Well, have Max check the door. So I can talk about this because I think there's probably a lot of people. You probably know a trader who's trapped from yesterday because they were, and I just don't care what they say to you. They thought it was going to close the gap. That's what they were doing. They saw it run down. It's going to close the gap. So excited. Okay. Okay. And candy? Somebody dropped off candy at our door.
Because my heart has off the candy inside. So I
Okay. Church stuff. Okay. So that's why they got trapped. They got trapped because they thought. So I could talk about these guys because if you know somebody who did it, I could probably tell you what they were doing. They saw some form of an oscillator give them a signal. They saw a nice juicy target. They were waited till here or here to hop in. Now they're stuck. This is what people do. Okay, so going into the close, there's really not much to do. Yesterday, we saw some algorithms moving down. Today, I don't think the algorithms make nearly as much sense because they're just upside down. There was no even sort of decent positioning. There's no short off the high. You know, if this keeps moving, you know, this will turn into something we're gonna have to pay attention to. But yesterday it was like hit their signal. They hit it. There was a little bit of an impact after. It took a little while. There's a little bit of an impact. Today, this position's taking a lot longer, but I still think it's a bad play for the bears to move the market down. So hedge your risk if you got it, but my expectation here is probably like 4,015 for the immediate, like into the, you know, overnight. But for some reason, I keep looking at this 4,005. I just keep looking at that. Like that's, I don't know. That's usually how I pick targets is I just look at the market and grab the first thing I see because it just tends to work better. But I think moving up higher, and the reason for that is I want to see tension curl. I want to see, okay, jelly beans. I want to see the market curl. I want to see these bears get out. That's what I'm looking for. Let's take a look at the options. I want to see if we have any further. Here's our in the money. Our bears are popping in right in here. If this comes down, you know, like yesterday we had to scroll this back. I just want to showcase a little bit. So the goal here is to get those in the monies. So here's an in the money. Hopefully for the bear's sake, it had a premium maybe about here, and it barely covered some short from there. So they have an outright, you know, it's a covered position. Maybe they captured a little bit there, but it would look something that this would be the objective. You got to cover out some of that risk if you're going to be able to hold this through overnight. All right, this is leaning down. When I say lean, terminology time, lean. When I say leaning, like leaning down, leaning up, I don't mean it's going in a direction I didn't anticipate. I mean it's moving towards a position. So when the market leans down, what it's doing is leaning down to sample the bulls. That's what I mean. I don't mean something else. That is specifically what I mean. And a lot of times what will happen is you get leans in the market, and they look a lot like this, where the market will lean into a position that's anticipated, and then when you get to that position, you can go, okay, that's where it was leaning to. And I think this market is leaning down, not looking like it's going to crash, looking like the bears are going to go ahead and try and get this down to the bullish sample. Tomorrow's Monday. Right. Yeah. Well, you know what? Maybe that's one of the things going on here is maybe the bears think, hey, the volume's going to crater because people don't really like holding on long weekends and stuff like that. Maybe that's the deal. I don't think that's a great play, personally. It's too obvious. Matt says, can you explain a little more the hedging with... Hey, you gotta build that door. Build that door and then show me. A big positive, is it that you need to make 100% with your original position before the hedge? Okay, right. So the way this works is that, yeah, you're treating it like a rental property. What happens is, let's say you go long, at 100 on something. There you go. You're at this, I don't know, I circle things. Whenever I scribble, I draw lots of circles. You go long at 100. Right, there's your position. That's a dollar sign. And price shoots up, and you're sitting at 150. And you're like, oh, okay, cool. Now, this only works it doesn't really work if you're under leveraged or no leveraged, because the returns aren't good enough. But it does work for over leveraged things like futures, because oh, sorry. Thank you. I keep doing that. So you get into 100, it moves up to 150. You basically have $50 in profits, and you have a choice. You can take the 50 home, or you can capture some returns. Now, what your goal here is to get any strike. If this is a long, you want to put, and you want your premium, which is this. You want your break even, your strike minus your premium or your cost, which is going to come back this way, to be above your position. So no matter what the market does, it really doesn't matter. You want this right here. This is your profit. So you might take your 50 and you give up like $35 into a put. And then you get to walk away no matter what, guaranteed the rest. So is that like $15? Now, this might look like, well, you're being dumb, but it's that upside potential. And the reason that you do this is for one reason. Are you ready? There's one reason to pick up a put versus just closing. Are you ready? Sleep. If you don't hedge your position, your eyes are going to be bloodshot tomorrow, because you're going to be up all night. You're going to be up all night checking. First thing you do in the morning, you're going to roll over, grab your phone. You check. Middle of the night, you're going to have a nightmare, stress dream, wake up, check your phone. You do this because you're a human being who needs sleep. So if you're not a human, you're an algorithm, maybe that doesn't matter. But I think most of the time, the best reason to do this, to give up some of your returns, is for sleep. So if you have an idea that it's going to continue higher, then you pick up insurance on your position. You do this with basically everything else in your life. And then you say, I'm going to go to bed. And then it gives you that capacity to wait. If you're not insured, that openness to risk will wipe out your ability to wait. You've lost your capacity to sit back. Like right now, the market's leaning back down. And it's like, well, yeah, we're going to get to this position. And the same thing yesterday. If you didn't pick up an insurance on your position, something where you can get this type of thing, if you can't get it, there's just not much you can do. I would just take profits. If you get to a point where you think it's going to start to move back against you, just get out if you don't have a good enough position to pull this off. Sometimes what happens is you end up having to go too high. So like, let me show you this. If you can get, so right now, if you were short right here, -1, you could get a break even that's below that. But you have to go way down here, like you maybe the 3,000 strike. But you're going to be putting so much money on the table. It's more than you've made. So the magic sweet spot here is that your rotating profits are greater than the premium to hedge that. That's the sweet spot. The reason that's useful is because of sleep. The ability to wait, it gives you a zero risk position with, they say infinite reward, but what they mean is the ability to potentially get the implied volatility percent, which looks like, if I didn't shut the contract or the chart down, this, I didn't. Okay, so implied volatility looks like this. Now I just did the downside on this, but if you go into your chart and you create an indicator, it looks like that. You just plot implied volatility. That's all I'm doing is plotting implied volatility. And I'm multiplying it by 1, 2, and 3. Implied volatility returns a number that's 1% of the current price. So what this is used for is this. The implied volatility number tells you where institutional level people, and this is the highest value. So implied volatility actually looks something like this, but it's the highest value of, I don't know, I don't remember what it was, like 100 bars or something like that. 153 bars. That's why it kind of has that look to it. But if this moves down, this is the first sigma move. That's what it is. It's 1 sigma. 1 sigma, almost 2 sigma. 1 sigma, bounce, 2 sigma, a little bit of a bounce, 3 sigma, and that was the low. So the reason you do that is not to capture infinite. It's to hopefully capture the an implied volatility sigma move. That's what you want. So at this point, if you're looking at this going, well, I think this could totally blast out the high. The question is, well, it's not going to go to infinity. And my best just eyeball estimate here is 4,015 before, the market's probably like cools off, but I'm thinking 4,005 is probably. Is that cost benefit in your head good? That's the question. And oftentimes just taking the position off the table is great. But if you're like, I think this is just getting going. I think that we got a day or two. The best way to play that is just pick up a put. Bet on yourself. Bet on the fact that you're an intelligent human being who can think for yourself and you can do it. And then one day you'll place a bet on the table. It'll work well. You'll get an insurance position. You say, I think this is going to keep going. And so you can hold on to it for a couple of days without sweating bullets and losing sleep and dying. And then you could potentially, if you had caught one here, sure, you gave up a little returns, but if you caught this rally, you're happy as can be. You're happy as a clam because you made, so like the philosophy here for me is not necessarily that there's some risk model. It's that you can't wait if you don't hedge your positions properly. And if you do it improperly, then waiting works against you. Like if you have your premium is greater than your rotating profits, waiting just means inching your way towards losses. you have to hedge it correctly so that you can wait, and that's beneficial for you. And that's just a philosophy that I think it works in real time for you to say, well, do I think this is going to do this, or is it going to do this, or is it going to do this? And it's going to do, if you think this is the one, yeah, I think hedging your position is a great idea. If you can get a put, leaves you with an end result of no matter what profits. Those are great returns. It's very difficult to get into a position and live for a week if you're a day trader, especially over leveraged. Oh my gosh. I've gone for 3 days, just 4 days, not sleeping because you have something sitting on the table and you care. As Matt says, thank you. So the strike your hedge at doesn't need to be at the money or out of the money as long, right? Yeah, and I like in the money positions. So if you're going to get a put, I like them above, and the reason for that is because there's both intrinsic and extrinsic value. If you get an out of the money or at the money, you kind of end up with just extrinsic, and that can wither away very quickly. I like to have a good potential to actually own something that retains its one-to-one value there. You're too far out of the money, and you can be right, and you're not right enough, which is really irritating. The market slowly moves down, and you have an out of the money put. Your premium, it can wither away, and you still lose even though you called the high. You can have that situation, and that is, I call it ratcheting. It's the ratchet. And if you are an options trader, you know what a ratchet is, where that they like sit and it's like, I was right, but I still lost. And that's one of the serious downsides of options if you don't use them right. I think of them as insurance policies, and yeah, as rental properties. They help you rent things out to the market. Now, you can use selling your position the same. So if you're here and you see the market's going to start moving back down, you could get it at the money or out of the money and just go ahead and sell a call. And, if it does blast off, yeah, you got to give up your position, but you get to keep the premium. So, if this is well, it's probably not that. So maybe like a 10 points, and you think it blasts off 15 points sure, you shaved off 5 points, but you get to keep that 10-point premium. You give up this. That's not bad. And if it does churn down, you get to keep that. So you got to use those positions as, I think, if you get into a really good one and it runs, you have to start thinking about how you deal with assets. Wealth isn't about paying things off. It's about taking the value you have and leveraging it in the right way to make sure that you're getting the most returns. I think one of the big mistakes that a lot of traders make when they come in and they're thinking they want to make big money is that you get into outrights and you hold for the whole trend, you buy the low, sell the high, and that's stupid. Nobody does that. Nobody. You buy into a position, you get your, hopefully you can pick out an intraday market so you can hedge your position, and then you manage that capital in a way to leverage all the way through the whole trend till it's over. And then once you deleverage your position, you unwind all your stuff, you end up with a net gain that's significantly larger than the capital you put in at the beginning. But it should be a rolling thing. You really shouldn't have if you're going to hold on for a week or a month or something, you really shouldn't have like, I bought a contract and then I sat on it for a month. That works with things that are not leveraged, like a stock, like Tesla or Walmart or Amazon, because it works that way. But something that's super over leveraged, like futures, that's a dangerous game to play. Okay, so you got me rambling about risk. Let's take a look here. Nothing new. Remember all these red ones, these are out of the monies. So what ends up being is that the premium on this is going to be significantly higher than the premium on this, meaning that 200 in in the money, 200 does not equal 200 out of the money. These are not the same. 200 in the money is significantly greater than 200 out of the money. It is not the same weight. And the reason for that is because it's the amount of capital you're injecting in the market. Now, on the flip side, 200 out of the money resists the downside more than 200 in the money. And the reason for that is because, so if this moves, if this is a put, or here we go, 200 right there. Oh, this is sort of at the money. Let's do this. 400. Those 400 shares are going to grow slower, right? So they don't resist. Like, they're not going to grow as fast, but once we get closer to them, there's this like intensity. All of a sudden it gets really intense. If I was to draw it as this. So all of a sudden this 400, because they injected so little capital, they create a significantly higher force to the upside because you contributed none and you're going to take a bunch out of the market. But this guy here, 200 in the money, contributed way more. And so the market can move in its favor because of the contribution to payout ratio. You actually increased market cap in your direction. So when I look at out of the monies and in the monies, I think out of the monies tend to create more resistance once you get there, but they have way less impact right now. So there's this like possibility space thing you have to think about over time. It's like right now, this is worthless. But if we move down to there, all of a sudden, this will be more important than this. And it's just part of how those work. So those are the two characteristics that I really look for. The ones that I'm most interested in the day, in intraday is always in the monies. I really don't pay attention to out of the monies that much. But if you're going to look at longer term analysis, like week over week or something like that, you'll want to pay attention to the out of monies and how the market gets to those out of the monies. And you'll find that they create supports and resistances because you didn't contribute. It's like you think that a transfer payment is somehow good for the economy. It's just moving the economy around. The people who make value, same amount of those. Why aren't we giving them the money? Value makers, people who build stuff, make stuff, improve stuff, do better, raise children. You know, options traders. I'm talking about options. So that's how I look at that. So right now, yeah, we don't see any calls coming in. I don't see any calls coming in to try and potentially, this is the position that I'm looking at going, oh, you guys, because yesterday these guys got a couple of calls, I think about here. Yeah, about here. They picked up a couple. And I think that helped them get this second algorithm and pressured the root position for the day. Today, again, I just don't think it makes sense to get us down to the root. I don't think we should give these guys advantage. We shouldn't move down and give them the ability to dump or anything like that. Yeah. Similar to yesterday, these 2 days to me look identical. They're just exactly the same situation. Predator bulls taking out bears. The one difference outside of the intraday market is tension. This is the differentiator. Yesterday was like negative 22%, and that's different. It's like elasticity doesn't make any sense, but now all of a sudden it does. So tomorrow, we talked about this, tomorrow it makes more sense for the bears to get out of the way and grab the highest possible price for elasticity so they have the most room to run down. That's more sensible. It's not sensible to try and front run elasticity. That's so dumb. Don't front run signals. These signals should never be front run. They are the front run. You really don't get any more front than this. The only way that you could get further in line, you know, is to know the intent before you see the action. You would have to have you'd have to say, well, I know that they're going to buy. And that's a dangerous game to play because what if they don't? What if they decide that you think they're going to buy and they're going to use you as liquidity? So I like to see the action and derive intent from action, not guess the intent and then look for the action to I don't know, confirm the intent. I look for evidence first. It's all evidence for me. All right, we're getting that sample. This is, so when I said lean, this is leaning down, leaned into a bullish sample. And we, I hate when they do this to me. Trapped orders just didn't happen. I need those trapped orders after the signal. Remember, this is about triggering snowflakes. People who don't know what negative numbers are. They think that negative means down, positive means up. I want to see the signal first, then the volume. Irritating, but okay. We'll wait for some trapped orders to come in. But nonetheless, we lean down to the sample and the market is just not even having it. So I'm not marking that as a position because the trapped orders was at or just before the signal. And I'm like, that's not how signaling works.
That knife.
You have a nut. Hold on. Okay. I had a carving things with a knife. There's not much here to do.
Wire for these holes.
Are we connected? I think so. Okay. One of the things I would love in Windows, and maybe it's just me, to know why it's making noises. I don't know if this happens to any of you, but like I get little bleeps and blips on my computer, and then you're like, oh my goodness. And you go over and you check the notification center and there's nothing in there. You have no idea what the noise was. And so you wait for it, you hear it again, and you're like, who's doing that? So you start shutting down programs. You ever done that? I wish they would give you like a history of who made what noise when and for how long so you could track it down. Maybe they do, I just don't know where it is. Okay, here we go. There's our trapped orders. They are coming in. We're at 11%. So these trapped orders, I think, are from this crossover. Market's leaned down. Now it's trapping in some sellers who saw that and said, hey, I know. What is this? Out of memory. Oh, I know what that is. A program I had running in the background. So they see that cross down. They say, hey, I know that negative numbers mean markets go straight down. So they start selling different stocks and things like that. Okay, that's better than a knife. And that's what we're seeing here, is that people reacting to the negative number, and actually those orders are being gathered up and sold. And it's right at 4,000. So this should be interesting. I was thinking today would be more interesting. If you remember yesterday, I was like, oh, tomorrow's going to be. But it gapped up through the high. It took all the fun out of it. So there was nothing left. Today had obliterated all of yesterday's nonsense, took out the highs, blah. So there wasn't much to do this morning. It was just, they took out all the fun. If we had opened here. Oh, that's so neat. Good job, buddy.
Someone keeps feeling me.
Oh.
Falling.
Oh, okay. That's smart. So if we'd opened here, we'd have had a little bit more drama for sure before things moved. Either direction.
Wires, Daddy?
We're almost done. I'm waiting for this to finish, and then I'm going to mark out that as a position. Now, remember, this is like a tertiary. It's probably going to be both. So it's going to be like a tertiary. So we have our root, primary, secondary, which I marked these because it was the same range, same. Oh, good job. Yeah, that's pretty cool, buddy. That is cool. Okay. This is the tertiary, so we're at a tertiary. Remember the rules here. Teeth are a common thing when you have primary, tertiary. Now, I think that a lot of eyeballs are on the 4,000. I think the people are looking at it. So we're almost done. I'm sitting here going, be done, be done, be done. Done. There it is. Okay, so we're all finished up with this sample right there. So you remember yesterday we kind of got in this situation. Remember it? Remember? We had the bears here, the bulls here, face to face, and the idea was, well, the bulls are in control here. They wiped out the bears really well. There was no elasticity potential. Ball game here is a little bit different. These bulls ended up not doing a whole lot, and then the bears ran an algo down to test the root position. So today we're going to see if we get a little bit of the same or if it's going to change. I want to see these bulls hit. I want to see a grand slam through the highs and elasticity curl, or sorry, tension curl. I want to see that happen because that sets up our elastic market tomorrow so much better. We sort of finished up everything today, tied it all in a nice bow, and then we get to see, and then tomorrow can be a nice straight forward situation. You can see that there's a little bit of acceleration there, and to me that looks like the bulls trying to hit this. They're having some impact, but you still need to see. I look for, the signal, the signal, the volume, at least a bit of a price response, something, a sweep. And if you're going to look at like a tick chart, so you go, it looks something like this, and then you'll see the sweep is where that you get, a couple of directional ticks, and usually they'll leave like a little gap there. And the reason for this gap is market cap. That's what causes the sweep, and that's what causes the gaps, is that cash gets injected so quickly. The market doesn't have time to let market makers do what they do, and you get these little gaps. So if you're looking at that, and they're usually like, 2 to 5 points in this market. Usually I look for like a 1 to 3, but, well, I don't know. The volatility the last two days, the implied volatility hasn't been too crazy. Usually it's like a 1 to 3. We'll just go back because it's not like insanity.
Daddy?
Yeah?
Thing that shoots a spring? Where is that?
Shoots a spring? What are you talking about?
That thing that was like a mirror. like it was round with a tiny round spot on top, and it shoots a spring out of the top. What is that?
Wait, it looks like this. It's round and looks like this, and it shoots a spring out of the top like that.
No.
I have no idea what that is. I'm just curious.
Those, it was like round and mirror shaped, like circle, and a tiny circle on the top.
And a tiny circle on the top.
No.
Okay.
The thing that shoots the mirror spring. And it was...
Do you know what he's talking about, Max? We have no idea. Anyone? You guys know? It's a circle, mirror shaped with a circle on top, and it shoots a spring. I don't have any idea what household item this is. 6 years old. Can't always figure. Okay, here's our price response. We got our little bit of a price response there. You see that? And you see tension curling up a little bit there. I think this is impact from the bulls, and I think the bulls have a single purpose right now. Wipe out these bears in a disgusting, despicable display of glory. Yesterday, right through here, we just weren't quite getting the awesomeness. We did get some curling up here, but I think the threat of elasticity was a lot lower yesterday. I know this is a crazy thing to say, but when you're not at the limits, things are a little bit harder to read. When you're hanging out near zero on things, here or here, I don't actually pay attention to these numbers, the McClellan oscillator anymore. But when you're near zero on these numbers, things get a little hazy and kind of tough to read. And the reason for that is because you have, well, first of all, if advanced decline is at 0 and you need to move it up to what would be considered strong, go to 1,200. That's 1,200 stocks. And if just buying one share per stock is $10, $100 on average. I mean, just think about the costs just go through the roof. So getting from 0 to 200 is expensive. The biggest algorithms that we usually see are like 150 stocks. We'll move over, so, here's your previous day's close, PDC, and your stock price is moving around. It's down, so you're pulling a -1 on the advanced decline, and an algorithm pushes you up past your previous day's close. Then you have a +1. 150 stocks getting shoved up is the biggest we really ever see in the market because it's so ridiculously, extraordinarily expensive to run programs that do that kind of stuff. So when you're near 0, the ability to kind of roll things up, good stuff. Look at that. Yeah, nice. With the stat ADI and its divergence, I'm more interested in the bulls side divergence with stat ADI most of the time. A lot of the time. So when it comes to the stat ADI being showing you bearish signals, what you need to watch for is, well, it's just like a little bit different. Like the stat ADI will do stuff like, let's say that this level right here, this dashed line is an extreme. If this pushes down to an extreme, I really like to look for these. But then let's say that this is the other extreme, this little tight, and it shoots up to the upside. A lot of times what happens is this ends up being much more of a pivot. Meaning that price, while price is following along, we could get that pivot right here, and then, it continues. And we see this situation a lot more, where we get these counter signals, but it's showing that we still have upside to go, and you create these pivots and stuff. Then we see the buy side. It's just over the years that I've watched it, I pay so much more attention to the bullish signals. And the way I'll use the bearish signals is to say, well, if stat ADI is getting close. You know, let's say this is the extreme again right here. Then you start to use this sort of like tension where you start going, ooh, we're getting close to an extreme. Is there a reason to continue, or should maybe we do something like that to kind of get away from it? And if you look at the stat ADI that way on the upside, where you sort of use it like tension, you say, well, is there a reason to get us up through there? You'll see a lot of times we get this sort of behavior while the price is doing this kind of thing. And it has to do with, if this blasted to the upside, we'd get a reversal, right? So if we don't want a reversal, then the stat ADI needs to constantly be cooling off. And then price will be able to continue. Otherwise, if we get that, price could follow along and we end up in a counter. So you have to be careful about on the upside. It's just the upside. On the downside, I look for major things. Oh, look at that. It's even more creative. Good job. Week to week. Okay. Week to week. And I would look wider than that, but I can't pull that much data into a thinkorswim chart in order to do much wider analysis. So it's typically week to week, maybe 2 weeks. And I look at those for week to month type of conditions in the market. So, if this 12 here is day 0, day 1, 2, 3, 4, 5, 6, 7, and that's a week. Then I'll want to look for signals where the stat ADI is doing divergences in this kind of time frame. Major stuff versus, day to day. And I see what you're talking about, and I don't disagree, but what you'll want to watch for, sorry, I'm leaning like this and you're going, what is he doing? The computer that streams that data is at this angle. It's up, way up there. I'm not crazy, I swear. It's going to create pivots for the market to bounce up. And on the upside, it tends to be that stat ADI's got to keep cool as things rise. And then you get these major pivots when stat ADI blows off the top. And a lot of times it'll use those to bounce off them. What? You can find one, bud. They're in there. Okay, so the bulls are coming in. Look at this. Look at this. We got our tension is moving up higher. This is great. Okay, so we're at our 405 level. That was the near level. I would love to see 415. The reason for that is I think 405 says, and maybe this is just me, you guys correct me if I'm wrong, but 405 says, hey, we're on the other side of 4,000. 415 says, hey, we got through 4,000. Like, we're going. Nice. So 415 it's like, feels like almost confirming. 405 just feels like, okay, we're still around the 4,000 level. And that's kind of in my head like, okay, that's I think how people would feel. Especially if you see 4,020. I don't know what it is about 20s, but markets just love 20s. Because you see 4020 and it's like, okay, we're in the 4,000s now. Funding confirmed, kind of thing. So 4020 would be, I think anyone who's bearish would be just like, crap. Tesla must have bought, how much did they buy a Bitcoin? Tesla must have bought $2 billion in equities too. And we're going to the moon. I don't know. I'm just kidding. My jokes aren't funny. Sorry, my mom is texting me a million ways to paint eggs for Easter. Easter's coming. Paint eggs with your families. Oh, that's so cool. Cool. All right, so let's take a look here at where they're probably going to be sitting their stops. I'd be sitting about here. That's looking at this, just the way it looks. I'd be sitting right there. So yeah, we're about there. We're to the 405, 75. We're getting to that spot. Tension curled up. You see that? So what's important takeaway here is this, the first part of this curl up was this bullish position, which started to hit, and that's That was great. And the second part, which is just, is going to be this liquidation here. The way you can tell a liquidation is pretty simple. If you're sitting and staring at this number, you're like, oh, look at it tick, look at it tick. And it goes 405.50, 75.50, and then all of a sudden it's like 407. So 40.07. I know, I'm going to say 407. You guys know what I mean. It's like, whoa, all of a sudden you see this snap where it goes right through like a whole point or something. That's almost always what it looks like when somebody gets their risk hit. You see this skip where it just whoop, all of a sudden, and you'll be able to see it. I mean, you'll be sitting there watching and go, oh, there it goes. Wow, you have laced that wire through that cardboard like crazy. So we're getting through there. You look for just a skip where it goes like almost a whole point and just like a real quick or something, or 2 points or something like that. See, there they are. And you see the acceleration on tension, and you expected it. We were looking for that kind of thing. And then you say, there they are. And that's a good spot to dump if you're looking for an intraday single leg trade. You say, oh, there they are. Here it is. And you pop. Otherwise, you'd pick up a put as best you can. One of the problems that ends up happening is that if you blast this market up, this vertical move right here drives your implied volatility up. And so your premiums go up. Usually in a blast off that wipes, your premiums are higher. And so, oh, that's cool. So getting a put here has a break even like that. Getting a put here may end up with a break even at the same place because your implied volatility went up and drove premiums. And it's really irritating because you're like, but I waited and I was patient. And it's like, well, you get the same reward as everyone else because this move up, the implied volatility is screwing over your hedge. So it's up to you how you want to treat that. You know, it's not always the case, but I do see that a lot. The verticalness makes that implied volatility number go up for a little bit, and you end up paying the same and sometimes more than if you had just picked up a hedge earlier when you hadn't got the blast off. Okay, so 2 minutes left, really quick before I lose all of your attention. Tomorrow, elasticity. Covered it earlier. Go back to where I was writing the word elasticity all over the page. Tomorrow, elasticity is the thing you're going to need to pay attention to. With a negative 48% here, we're getting close. If tomorrow this continued, we'd be running into 70% in just like an hour or two. And if this gapped up, we'd be hitting 70% really, really quickly. So remember, it's not over yet, but I'm trying to get you ready so that tomorrow you see a bull sample and the bulls do nothing. Don't be surprised if the bears get really excited about that and go to hit some liquidity. You just need to be ready for it. However you want to handle it or whatever you want to do. If you think that you're going to hold through the elasticity and try and catch a second leg, sure. If you're a big old swing trader, that's fine. I just don't want you to get blindsided by this thing that could happen tomorrow and like, oh, why'd it come down? How could it? We can see that that's a possibility today. Tomorrow will be elastic. That's like the beautiful thing about this. We can see what tomorrow's conditions are going to be. And that's the most important thing you can have. It's so important that you stop looking at the past. There's nothing in the past. Sure, we do pick up little levels and stuff like that, but I don't go, well, this was down a lot, and so it means I just look at the positions and sort of figure that there's just nothing in the past. If we could just get rid of the past in your analysis, you'd be so much better off. It just does nothing for you. As far as I know, all the past has ever done for me is convince me that there are guarantees where there were none. And convince me that there were profits untold where there were none. My experience, 90% of the time, the past does very little to serve the future in trading. If you spend too much time with your head faced the wrong way, you're faced the wrong, I mean, all the profits are in the future. And fundamentally, if the way to make profits is to get in when there are none, watch them develop, and then get out before that there are none again. And that means that all profits in real time look like $0. Every time you take a position, the profits on that trade are nothing. So it's consistently true that the trades that are the best look like their profit potential, or their profits here, are 0. Because profits are inherently a future thing. They're always 0 now and 100 then. And so looking back, it always looks great. Looking back, you're always like, oh yeah, if I'd held on to blah, 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 blah. It's like, well, no, you need to stop focusing on the past. You need to stop looking at these moves up and down and saying, how could I have captured that? You need to start looking at the future. Oh, profits are permanently pegged in an unattainable future that you can never own or acquire. It cannot be yours. Anytime that you move profits out of the future into the present, it's called theft. You're not allowed to do it, because that means it's not a transfer of value. It's not an economy. It's you being a dictator or a totalitarian or a thief, and you're taking value where you contributed. Value or profits should always be pegged in the future, out of reach. Always, always, always. You should never take a trade that's already profitable, because that means the profits are in the present, and you can't do that. You can only get into trades where the profits are out of reach. Nice. Oh my goodness. So that's a big deal. When I'm always talking about stop looking at the past, because so many people stare at the past to find their profits. And so you'll find yourself sitting right here looking this way, and profits are over here. They're in the future. So you need to turn around and start going, what's next? Where's it going? Where's it going? And stop using the past. Stop it. Just stop it. That's why a lot of the times I don't use a lot of the levels that other people do. Trend lines and things and price action. They're also oriented. And that's why I like possibility space and stuff. So you have to remember that. Good traders never really feel like they did much. I mean, I don't know if you guys have ever experienced this, but having a big pile of money feels like nothing. Chasing a big pile of money, however, feels like a lot. It's very dramatic to chase things you don't have. It's very empty feeling to have a huge pile of cash. It's unsatisfying. And so good traders tend, I think, to not really ever get that excited, because the profits are always out of reach. And then once you get them, it wasn't really all that surprising. And it's definitely a dopamine rush, but I don't know that it's as exciting as it looks in the movies. I think it's just what you do. I mean, you see it, it makes sense, you go for it. It works. And then what? The sad, sad, sad truth about money is it's very unfulfilling. So when it comes to trading and you're looking at your trading account, really you should realize that excitement is not a function of wealth or profits or growth. You can't ever own profits. You can't own that exhilaration that you're chasing. You can't. So that's my spiel on profits. Maybe that's useful, maybe it's not. So we got what we were looking for here. I think we have tied this up in a nice bow. We got right up to, how I did 12, 40, 12, not quite 40, 15. I do think that the 20 markets love 20s. I don't know what it is about a 20. Maybe it's a $20 bill. We just get excited about $20 bill. So, $20, $20 you can do stuff with, which probably isn't going to be true for too much longer. That 20 might move to 100. $100 you can do something with, because $20 is on the way out. But the 40-20 I think is kind of, is it just me? It's like, hey, it's like, we're in the 40s now for sure. 40-15 confirming 40-20. It's like, just give up. So that's kind of how I'm viewing this. I think this is buttoned up. They tied it in a nice bow. We wiped out probably all the bears from the past 3 days. Anyone who has decided that they're right and they're going to pay to have that experience. Tomorrow, I'm going to be watching like a hawk for elasticity off the open. So I'll post on Twitter or in the Discord if I see that happening. Like, because that's the thing we're expecting. I'm going to be paying attention to that. And tomorrow, if it happens, I'll be like, oh, look, the bulls missed. Hopefully you go, oh, I know what you mean by that. Or, hey, the bears are coming in to try and drive elasticity. Be prepared for that. So that's where we are. There's, I don't think there's a whole lot to do here. As far as I'm concerned, moving up is the most sensible thing for both people. There's just not, why would you move down? If we move down, that just means the bears get worse prices. The bulls get worse prices. I think right now everybody wants a little bit higher prices at least before we look at elasticity. So nice. So that's what I'm expecting. You know, to hang out here, move a little bit higher overnight potentially, and the elasticity tomorrow. And we'll see how that goes again. Okay, it's been a good couple of last 2 days. These markets are kind of fun, especially when they get directional. They're just lots of fun. All right, guys, I will be back tomorrow. Good luck trading.